First off, Marty, I want to thank you for having us on this panel discussion and hosting this event in beautiful South Florida this morning. You guys thought you were coming for some sunshine. It'll get warmer later on during the day. We'll promise you that. My name is Mike Boggiano, Director of Commercial Lending for LendingOne. We started off as a fintech company. I'm a plain vanilla commercial lender. We were just recently acquired.
Raise your voice, they can't hear you.
Can't hear me. We were just recently acquired by Blackstone, so we have institutional capital behind us, but you're not here to listen to my platform. I have a distinguished panel of 3 industry experts. I'm going to do a high-level introduction, and then I'm going to hand it over to them to be able to discuss the benefits of their firms. So first up,
I'm just going to throw out that the one thing about scanning that you have mics in front of you, but it's for the electronic. It's not just so you really have to think of yourself as being a theater full of people that you're projecting to. When it's so just throw that out there. I'm up there on the stand.
okay, Brad, I appreciate that.
So I didn't hear a word you said.
No, I'm actually from Boca Raton. We're based out of Boca Raton. Okay, we'll start again. My name is Mike Boggiano, Director of Commercial Lending for LendingOne. We started off as a fintech company. We've grown into a several billion-dollar a year origination company. We were recently acquired by Blackstone, so we have institutional capital behind us. We do understand the alternative space. Initially, we were funded by several family offices, so that's where our start came from, 2014. Fast forward to where we are today, we have institutional capital behind us. But again, you're not here to hear me talk about my platform. You're here to discuss alternative credit. I'm going to introduce the panelists that we have lined up. First up to my right is Wissam Otaky. He's with the Leste group. He's Manager Director of New Initiatives and Global Ventures. They're an international company based out here in Miami. I also have via Zoom, Alan Snyder, Managing General Partner of Shinnecock Partners. He's based out of Los Angeles. And finally, I have Douglas Benoit, who's the Chief Strategy Officer of an international cash fund in LLC. So with that, I'm going to hand it off to the panelists to discuss their companies and go from here.
Sure. So guys, I'll try to project. So if you can't hear me, let me know. I'd rather avoid standing because that's just going to look awkward. But my name is Wissam Otaky, as Michael mentioned. MD of New Initiatives and Global Ventures at Leste Group. We're a multidisciplinary alts investment platform and a hybrid family office. We're about 100 people, offices in Brazil, here in Miami, New York, and London. And we really invest across the alts universe. So we've got what you can consider traditional alts, so credit, real estate-backed credit, real estate equity, and then we do some more exotic, higher risk return profiles. So we've got venture, private equity, litigation finance, which I think Jim mentioned earlier. We have a growing venture debt business and a pre-IPO secondary business, and then some special situations credit. So we invest in everything we do, but then we bring on board other family offices to invest alongside us. And so it's really an institutional platform. Doubled in size last year, hopefully looking to double this year, and we continue growing down that path. So excited to be here. Unfortunately, Alan and Doug couldn't be here in person, but this is my first panel since pre-COVID. So this is great. I'm all for it.
Excellent. Thank you. Alan, you're next up. Alan gets the long distance award. He's, again, based in Los Angeles. It's early out there. We appreciate you joining us this morning.
Well, it's been a good start to the day. Listening to my old friend Chip Perkins give his steely-eyed view of the world, and Ed or Denny talking about the threat of inflation. I'm the founder of a 30-year-old family office investment boutique. I started after leaving Wall Street, where I ran, and maybe they ran me, most of the product areas for what became Morgan Stanley. My swan song there was starting with Discover Card. From there, I went on and did a bunch of other stuff. For anybody that's at a computer, you can learn more. I won't bore you with my checkered past. Go to Shinnecock, that's SHINNECOCK.com. for more on me and us. And 6 years ago, we found a phenomenal space, which is lending against museum quality fine art. We were looking for yield investments, and we've done about $100 million of secured hard asset art lending. Doug, off to you.
Hey, Alan, 1 second. Your audio does not come out great. Maybe there's some way to increase the volume.
Okay, I'll do my best.
Okay, figure it out. Doug?
All right, thank you for taking the time. I'm Doug Benoit with International Cash Funding. We are a direct lending platform that very similar to my two cohorts here that invest directly into the projects that we're dealing with, and then we bring in additional partners or funds or hedge funds or whatever it be. We're not as large. We do invest around the world. Some of our recent projects have come from Australia and the UK. We grew from 2001 to date. We started in real estate, and then over time we bought and owned businesses, sold them off. And as we scaled past 2015, we started getting into private equity a little bit here and there. So we look at the opportunities, the way that, as far as an analogy to people, I say that you have your bricks and your wall foundation of partners that are out there. We're the concrete or the mixture that holds the bricks together because we directly invest in. It's built on relationships, and we look for opportunities that are out there and not necessarily their past. So we always look forward to the future because everything is constantly changing and adapting to what we do. As far as a person, I'm a veteran. I've served in the Marine Corps. I've been deployed 3 different campaigns. One thing that I've learned and carried with me throughout every business that I get into is transparency and communication, because without those 2 things, I don't care how great you are or how many $1 billion you're going to be. We need to know what you are doing and how you're doing it and how we can get you to reach that next stage. So thanks for time here. I look forward to this discussion.
Fantastic. Great introductions. Something that just popped up in the news again, as we thought we were turning the corner. How has COVID impacted each of your individual businesses from the start to where we are today? And then just looking out into the near future.
I mean, I'm happy to take that. So our model is a little bit unique. Every sector we invest in has essentially its own business unit, its own investment team. They're invested in the strategy and we back them. And then, like I said, bring third-party capital in. But because we're so diversified, every sector has been really impacted differently. So, you know, we have some hospitality in our real estate equity portfolio that did struggle a little bit and is thankfully now coming back. You know, unforeseen what's going to happen with Omicron. I don't even know if I'm saying that correctly. Our credit guys, both on the real estate backed credit and on the venture debt side of the business, which we're going to get into alternate lending in detail. But those 2 sectors have done very well, and really I attribute it to just the deep diligence that the teams do before they put out any capital. And so, you know, it hasn't been great. We've had to figure out how to work remotely. More recently, we've all been back in the office. But from an investment perspective, at least on the credit side of our business, really kind of tried and tested our diligence processes, and so far so good.
Very good, thank
Doug,
you.
maybe over to
Doug, you want to jump in on this?
Sure. I think COVID was a great opportunity to filter a lot of business out. We've spent a lot of time on the road traveling to sites, and it was a waste of time. Good, bad, or indifferent. And I don't mean to be negative Nancy on it, but the opportunity of it kind of fast forwarded everybody to getting through the video into the technology, to understanding what voice over IP really is and what it can do. I mean, we communicated overseas multiple ways, but with VTC, gets everybody on board. And if you have a good product, you have a good pitch, you can do it quickly. You don't have to increase the overhead. And it just fast forwards everybody through from A to Z. And now we can talk business and not have to worry about the dog and pony show. Is about getting around a table and saying, hey, is this a real deal or not? So it's a great opportunity. Kind of like Wissam said, it's definitely a way of the future. It's changed a lot of ways that we do business, and I mean, it works out. It's good for all of us.
Thank you. Alan?
Well, I'm kind of excited about what we're doing. Better to be lucky than smart. The art world, since we're hard asset lenders, we take control of the collateral. The art world, in March of 2020, imploded a little bit because all of the sellers were shut down and had to adjust to become virtual. Yeah, the major auction houses, about $60 billion a year trading, adjusted, and they created virtual auctions. And as you all have read probably in the Wall Street Journal, the art world is booming today. Maybe it's the threat and scare of inflation, art assets is a good thing, and maybe it's the creative adjustment to doing virtual auctions and virtual sales, private sales. So COVID has not been a problem for us. We've sold art. We have about, 165 pieces of collateral. We were able to sell collateral when we wanted to during 2020. Certainly this year has been facilitated by the robustness of the market, which we see continuing. So COVID has so far not been a major issue for us.
Very good. I mean, on Friday, we saw a major sell-off in the markets as a result of South Africa announcing the new strain. Is that a knee-jerk reaction? Because we've seen markets bounce back a little bit today in terms of the equities, and we've seen some yield coming back as well. Thoughts on that?
So like I'm predominantly a private markets guy, to be totally transparent. I think that you're bound to see these types of swings because nobody knows where it's going to end up. But again, from a private market perspective, it's really business as usual. I think Chip alluded to this earlier. There's a ton of capital out there. It's looking for yield, and that yield isn't available in too many places. So for us, we just we keep pushing along. I think you're going to see this until it's completely under control. We're going to see these swings and these knee-jerk reactions both up and down.
I'll jump in. I love having years ago run a $20 billion portfolio. I love niche investments. I think COVID will have some impact, not so much on the art space, which is my focus today, but think of litigation finance, which we've invested in. During COVID, anybody that likes lit-fi, you had this incredible extension because the courts became closed. And if COVID really takes a hold again, I think that's a sizable risk to the litigation finance world, because you'll have extension risk if the courts close and can't clear cases and get the payments which litigation investors want. So I think that's an impact.
Doug, you still with us?
Yep. Yeah, I'm with you. And just, I know we're dancing back and forth. So rephrase the question about what you're looking for on this, and that way I can narrow it down.
Was Friday a knee-jerk reaction to the new strain that came out?
Yeah. All right. Yeah. Okay. That makes sense why Wissam said what he said. Yeah. I'm not a politician. Don't plan on running for politics anytime soon. So it's good to know people up to that point. Volatility drives the market. We all know that. You put the fear of God in people, they're going to respond a specific way for so long, and then it's finally going to pan out. Like one of the things I think that makes all of us that are sitting at the table right now in our market is that we look for something that's more recession proof and worried about the high volatility. And that's really where all our investors go. primarily it used to be 80-20 on the real estate, private equity. Now we're about 60-40, but it still has something to do with the technology or capability that's going to be there, whether we take a crash or not. And that's why manufacturing is really strong. Real estate based lending is really strong. So yes, it may be, but I don't have a very savvy answer for whether one way or the other on Friday. Definitely a reaction, but I'm not in it. So, and nor are my investors. So we're happy.
Very good, very good. Actually, it's a good segue to the next question. Where are the opportunities today for investors in this market?
I mean, since we're going kind of in a circle here. So we love the alt credit space. I think it's a big part of our business. We do a lot in real estate backed lending, but now, as I mentioned, we're expanding into venture debt. And that's a really interesting space. It's very, very resilient. Its default rates are, sub 2%, where SME lending default rates are in the 17%. If you have the right team in front of it, doing the diligence, finding the right opportunities, it's a great way to access potential venture capital kind of outsized returns with a layer of downside risk protection because of those types of default. So we think the alt space, our investors at least and ourselves, we're continuously looking for opportunities there. We think credit is a unique one, like I said, and we keep looking at new sectors to get into. So we're looking at lending against content creation and all sorts of other fun stuff like that, where you can do something that the markets aren't really behind, or the markets don't have the capacity to finance.
Very good. Doug or Alan, you can jump in.
Alan, you want to go, or you want me to break the circle?
Sure. Well, the reason I'm excited is I think the bottles of sunshine in the private credit space. It's most unusual to have
Alan, we're having a hard time hearing you.
Is that better?
Yeah, that's better.
All right, I'll snuggle up to this microphone.
Your video. If you turn off your video, it might be better.
All right.
But he's good.
I'll save the audience.
No, you just have to be close to your microphone. You were perfect. It was a video hug.
Much better.
Leave it on or leave it off?
Keep the video off, yeah.
All right, video off. Thank God for the audience. Okay. I was sitting around one day and I said, wouldn't it be neat to have some of the stuff that we're doing credit rated? So, to my amazement, we were able to get the last deal that we did rated. Here's a 1-year term loan and no accounting for taste. It was rated an A-. And so now we've got private deals rated by a rating agency. And, I just think it's an incredible good fortune for us. So we can have a 1-year term loan rated investment grade, yielding 11%, where we control the collateral. So if somebody were to default, we'll sell the collateral. Now, 4 years into it, we've yet to have a default. That's kind of cheery. Wall Street guys say, oh, Snyder, you want to have a default because your LTVs are so low. Currently on a deal we just launched, the LTV is 39%. So I don't know, A- rated deal with that kind of yield warms my black heart. So that's kind of fascinating stuff, and why I think losing money sucks. And if you can get that kind of yield with that kind of security, it has my capital in it.
Alan, what was the leverage on that transaction?
Zero. 11. I mean, better to be lucky than smart.
Yes, sir.
question is, who wants to borrow?
The
Wants-
question,
Go ahead.
just want to make sure you guys were able to hear. The question is, who wants to borrow?
There are two primary segments we play in. We lend to galleries and dealers and high-end collectors. I particularly like galleries and dealers because if you think about it in the art world, if they were not to play it straight with us, they run the risk of losing their reputation. So there's this moral weight that they want to play it straighter. So that gives us an extra edge. Now, in addition, maybe belts and suspenders, all the loans that we do are recourse. And not only if it's to an entity, it's recourse to the entity, and hold on to your knickers. We also get personal guarantees from the principals as an additional motivation to be sure to get paid back.
Excellent.
Doug,
Yes. All right. Hey, good. Thanks, Alan, for the setup. The so opportunities that we look at, we're agnostic. It really comes down to what you need, what's your timeline, how can we get there? We like the asset based behind it. How our investors, when we're sitting at the table, how do they increase their yield or what they're looking for? How do we secure it? Very similar to what Alan says. The borrowers normally put a PG of some sort. We usually collateralize their assets. If we bring in an IB and they're taking them public, you have your UCC. So pretty much everything that's normal. The difference is when we get in, there's some reason or another why we're brought to the table, and as an alternative type of financing. So we cover the scraps and bits and pieces. We don't have 50 billion that we can write a check for and cover everything, but we can cover our bridges from 1 to 3 to 5. We could probably do 2 to 3 a week. We normally don't keep more than 5 to 6 projects on hand that we're actively invested in. Otherwise, we'll help build people up and hand them off to someone else. So it's always good to have more family offices or people like Wissam that we say, hey, this one's outside of our pocket range. We're invested for 500,000. Can you carry us the rest of the way? So sometimes we can act like a lead or a syndicate, but we're not a broker dealer. We're really private money. This comes out of our check accounts. We give friends phone calls that, hey, you want to come in with me? We can do JVs. We've touched things from oil and gas operations and the extraction sites throughout the Midwest. We've created a database for cryptocurrency because the volatility that's in the market, we figure, hey man, it could go up or it could go down. It doesn't matter. We have the platform where we can trade in and out. So we can go from Bitcoin, Coinbase to Vert. It doesn't matter. We have that platform now. So the opportunities that are there, the PG, another local, well, not really local, he's up in New York, but everybody knows Michael Trebele from Vonage. Had the opportunity, we're working together right now. In fact, later on this week, we're gonna have some big public news coming out. That was an opportunity. It was a phone call with a friend and say, hey, this is what we're doing. We're like, hey, we got a little bit. And it's all about the relationship. So opportunities are there across the board. And Victor Sears says, hey, what did COVID really bring up? Well, that's really what happened for business opportunities that came across. It's just people talking, a lot of real estate. I know that, and then Wissam, you probably touch base on this too. But with the direct land lenders, it seemed like everybody went off the face of the earth last year. Like nobody wanted to touch land. If you went above 30% LTV, it's like taboo. If you were investing, we got a lot of our investor bases in California. Nobody wanted to come out of California. Nobody wanted to touch Kansas or Ohio or, where other business was still going on. So a lot of opportunities out there. Like this market. We're there. We're at that early stage. We're always looking for bigger players, family offices that are willing to pick up where we can take it to or hand off.
By the way, there's one interesting thing since most of you are in South Florida and may have offshore capital. The interesting thing that we discovered is that in a direct loan participation, according to Spicer and our lawyers, it's kind of fascinating. there is no effectively connected income in these sidecar deals that we've been doing. So that's like getting an additional 200 basis points of yield pickup because you don't have all the infrastructure of a blocker offshore, which costs about 200 basis points. So you can skip that and still get the benefits of the direct yield and US regulation. Kind of fascinating.
And I would add to that, what's really interesting about the US market. So a lot of us come from emerging markets, be it Brazil, Middle East, Asia, et cetera. And there, you never see cost of capital as cheap as it is in the US. I mean, rarely do you see that. What's interesting about the US market, especially in alternative credit, is if you check all the boxes, you can go to the markets and get free money. I think somebody mentioned it. It's essentially free. If out of 100 boxes, you're missing one, the spread for you to borrow money goes up 10%, 1,000 basis points in some cases. And that creates a tremendous opportunity for allocators like us, because again, if you have the right diligence in place, they're able to take advantage and generate this alpha for your investors, as long as obviously, again, your diligence. And to address the question, sir, I think you asked who wants to borrow. When we look at specifically our venture debt field, this is an industry that's now grown 6x in the past 10 years. The reason it grows is if you're a venture capital backed business, you're a founder and you're doing great and your company's growing through the roof, if you go out and raise equity, you're going to give up 20% of your business for that next round. And that's the most expensive capital you can ever raise. So what a lot of these founders are doing, and they're coming to firms like ours, taking on debt, a small amount, they're not over leveraging themselves, and they're typically backed by VCs, and the VCs like this as well, to reduce their dilution, maintain their ownership, grow a little bit further into their next valuation. And so again, it provides this opportunity more so in the US, I'd say, because this is where the bulk of that sector is, for non-standard businesses. Because if you were an SME with regular cash flow, you go to the bank, you borrow, you get it for 6-7%, and you'd be on your way. But if you're a high growth, cash flow negative business, you need an alternative source. And so you as a lender, you get that extra little bit of spread. And specifically in venture debt, you also get some warrant kickers that take your upside, hopefully, into the 20s.
We have about 5 more minutes. I do have a question. You're talking about lending in emerging markets, or we're in Miami, so a lot of South American lending. So are all those loans denominated in dollars?
So for us, venture debt is purely US and Canada.
Okay.
That's where we focus. And there, even in Canada, it would be a US dollar.
Right. Right. Fascinating times in venture debt. Although I don't know if venture debt has actually increased proportional to valuations.
So it hasn't. And I think in terms of size, we're going to see a lot more growth over the next few years. There's already a ton of players in the late stage. So when you're talking about the billion-dollar businesses that are raising $300 million rounds, they can get $100 million. Again, we look for spots where the larger players aren't participating. So we'll lend to a Series A business that's showing that growth that's back, and we'll typically give $1 to $5 million loans, and we'll syndicate up to 20. But we usually, and I think it was maybe Jim that mentioned this earlier, or sorry, it was Doug as well. We'll lend to a business in the anticipation that their next venture debt round, which comes from Silicon Valley Bank or any one of those big guys, is used to pay us off. And so we just give them a little bit of an extra boost to grow into their next valuation faster.
So we saw a lot of, I would say, a revolution in lending, not just, Alan Snyder with his ability to find, new niches, but at the same time, from 2008, we saw the marketplace lending, companies and, many others. If you were going to prognosticate, what are your thoughts about, besides venture debt, where there's going to be, debt offerings that we haven't seen in the past?
I mean, I've got a couple of thoughts, but I'll let the guys go so I don't monopolize the conversation.
All right, Doug.
Okay, well, I really can't add to that one. It's a thought process. It's about thinking about change. In 2009, 2010, we took a significant hit in what we were primarily interested in, and that was real estate. And now if we venture forward about private equity and the direction that that's going, everybody's changing or adapting. I know a lot of people are worried about the market crashing again here within the next year. We're not sure what's going to happen with the feds trying to stick their fingers in the crypto market. I believe Ed Yardini was on earlier. He had a lot of key points about the direction out there. Very conservative base there. I agree with him. I mean, you're not sure. Depends who's in charge, what politics are in place, and the direction that we're in. So every deal is different. That's what I go back to every time. Because the interest rates that we charge, it fluctuates. The points that we charge, if we're doing bridges, that's 3.2, 3 on equity, 2 on debt, less than a point, 6.5% APR for the year. So everything changes. I don't want to ramble on about it, but so every deal is different. If you're a manufacturing site, we look for the things that are stable, things that are needed, like Hawaiian Springs, a water company. Okay, they need growth capital, so we're in there. Yip TV streaming, they needed the go-to-market capital to get them to this point where they're at now. So it really depends on the company, depends on the asset that they're holding. Sometimes they don't have real estate, but they got a heck of a growth plan, or they have an executive team that is impeccable that you really can't compare with. So we invest in the people. It's personal relationships. We put our own money in before we pick up the phone and call other people to come on board with us.
One thing I'll add, Wissam makes some great points earlier. You think about it, what's the appeal, Marty, is high yield debt. You figure a high yield fund is yielding about 450 today. So it's a blend of triple Bs and double Bs, and it's yielding 450. We're yielding substantially above that. And you look at most investors are, take pension plans. They've compounded money roughly 6%, endowments maybe 6.5% for the last 10 years. And here you can get a much higher yield. If you structure it properly, you can be secured. And I would argue consistency in performance or compound returns are the 8th wonder of the world, which is why in our case, we really, we do a lot of stuff, as you know, Marty, but we're very enthusiastic. Having an investment grade deal that's yielding what we're talking about here is just, I pinched myself and got lucky.
Hey, Alan, I got a quick question. I just got a letter in the mail from American Express. They said that if I put money in their savings accounts, they'll give me 0.4% interest a year, high yield. Does that sound good?
Marty, rub it all over your body.
So Marty, to your point, one other place that we're starting to play, and you guys may have heard this already, is buy now, pay later. So BNPL.
There you go.
I mean, it's exploding obviously with the likes of Klarna and the rest of the world. And again, kind of a testament to the way we do things. We'll find a sector that we like, a team that's an expert at deploying the capital, bring them in-house, build a business around this. And so we've got a team that helped build essentially buy now, pay later for your mobile phones back in the days of Sprint. And it's a sector that we're treading carefully into, but there's a ton of capital behind it. There's a ton of opportunity, and it's really only enabled because of the technology and the ability to get capital to the consumer quickly, which wasn't possible before. So it's a space we like.
Great. Rob, we had a question.
Thanks. Speak a little bit about headline risk and bank forbearance. You can see that as COVID stimulus spaces out, but actually the other side, as vaccinations become more prevalent, that there's less bigger banks with less worry about headline risk. So we're apt to be more active in their collections.
Can you repeat the question?
Yeah, I believe the question was, can you explain or the headline risks that banks face with forbearance on a go-forward basis?
I mean, Doug, you may be better suited here. The only thing I can say is we don't play where the banks play, because then there's no money to be made. So we're typically lending to organizations and groups that, again, don't check one of those 100 boxes. And so sometimes banks can't even go near them.
Yeah, I agree. That's literally, we fill the gap that they won't. So sometimes their balance sheets are upside down, or they just they need a new acquisition, or they have a business that they're going to be able to acquire for pennies on the dollar because of a distressed situation that's going to leverage their assets. And then once that's all acquired clean, it's like, go now we can refer them to go into a bank or go to DNB or whoever and say, here we go. Now we want to do a qualified loan. It's just better. Yes, we're all in it to make money, but we get it on the front side. We minimize the amount of risk. We turn around. My biggest point is, yeah, we get a few points, like 3 points when we're doing a deal, but it's when we have warrants that we can exercise. That's what our goal is. When we can get a 10, 20, 25 times return 2 years down the road, I'm not struggling about the few points or the interest rate. Because a common loan that we can push out is around 10%, and that's just private money. Go as high as 14, and then you feel like you're robbing the bank. But it's really not about that. It's that 2-year exit. Hey, where are we going to be at? What are we going to do? What's the next project? Minimize the risk. Everybody wins. And then they come back. Like Wissam will say, a lot of his business is word of mouth. Same thing with Alan. I mean, nobody knows about art financing, but this guy's a pro at what he does. And I would take all my projects to him for that specific niche. So, like you said.
It's interesting, Marty. Banks, at least in a lot of places we see, are cash flow lenders. And as I said earlier, we're doing inventory finance for these dealers against a hard asset. And banks are really not set up to do hard asset lending because it takes a lot of work. In our case, you got to review both the borrower, which we do. We try to avoid bad actors, even though we're primarily looking at the collateral. I mean, if we can lend money against Picasso's, Rembrandt's, a Bacon painting, which has a fair amount of frequency of trading in the marketplace, you really have comfort, peace of mind, and the ability to exit. We haven't had a default, but if you do, you've got major auctions every 4 months. So you can sell the art because it's in directly our control. You're not going to chase an equipment or an auto. We've got it. And we'll give 5-day notice to the borrower and say, hey, thanks. Sorry, too bad, so sad. If you were to default, we're going to simply sell the collateral. Big difference. And same, I'm sure, for Wissam and Doug on real estate they'll foreclose.